Welcome back. Well, the global growth outlook has been slashed to its lowest point in a decade after the International Monetary Fund downgraded forecasts for Australia and elsewhere and backed the Reserve Bank's move to cut interest rates to a record low. What does this all mean for our economy? What does it mean to consumer and business confidence, which, as much as government, is crucial to getting things back on track? Joining me now is my economic panel of gurus, Terry McCrann, economics columnist at the Herald Sun and Australian newspaper, Dr Andrew Stone, former Treasury and RBA official and chief economist to the Prime Minister, and the Australian's economic editor, Adam Crichton. I want to start with you, Dr Stone. You're right here in the hot seat. What did you make of the IMF report?
Well, it is concerning, actually, that the IMF has further downgraded the forecast for global growth. It's mainly concerning from an Australian perspective because the big risk is that we are much less well prepared for a serious economic downturn than we were in 2007-8, when just directly before the global financial crisis.
And that's because you're talking about our debt load and the fact that we don't have cash in the bank in the way that we did in 2008, 2009.
So budgetarily, we'd run 10 surpluses out of the previous 12 budgets under the Howard government. We had negative net debt. We actually had money in the bank. The cash rate was up at 7.25% before, so there was plenty of room for the Reserve Bank to very rapidly cut that and provide tremendous relief to families. And also it happened that we were serendipitously in the middle of a major mining boom, which was then in fact turbocharged by the fact that the Chinese then, in the face of the global financial crisis, instituted this massive stimulus package that created enormous demand for our iron ore and coal. If you look at the situation now, our cash rate is already below 1%. There's almost no room to further cut it, even though our household debt is actually higher than it was now, significantly higher now than it was as a relative to household disposable income than directly before the financial crisis. We've only just got the budget back to balance, not even to surplus, and our Commonwealth net debt is currently at a record level as a share of GDP for the post-war period. And our terms of trade are quite elevated, and there's no likelihood, there's every possibility that if there were a big downturn, it might be centred in China rather than us being saved by China. So that's the real concern. We're very much more exposed to such a downturn.
Terry McCrann, forecasts are a bit like, economic astrology, but these forecasts, I'm always nervous of the Treasury forecasts, which are always upside until budget night when you go to the papers and the upsides are no longer there and they push the upside out even further and, it'll come, and it doesn't. I've read too many of the Wayne Swan budgets in my time, but how much do we believe these forecasts? So what's your take of the IMF's report?
Well, I've long since lost any faith in forecasts, Peter. As you say, the one thing we know about forecasts is they will be wrong. Let's hope that these, as you say about the Treasury forecasts, don't prove to be optimistic when we actually look back on the year. Picking up on all the points that Andrew made, all of which are exactly right and exactly concerning. We don't have any ammunition. This is not 2008. We don't have that high cash rate. We don't have the budget situation we had then. We're just on the verge of getting finally the budget back into the black. But to me, and I think in the most basic sense, these forecasts are just catching up with the reality that we all know it's out there, that the economy is soft, that we've had an entirely based on the construction and property cycle. But having said all that, the real thing that really concerns me is the disconnect between financial markets and the real economy, and that's not just locally, but globally. Financial markets are booming. Wall Street's about to hit a new record. And the global economy is weak at best. That's not something that is a healthy combination. And I think it's building up to really not only have a problem in the real economy, but we also face the prospect of having a bust because of this completely crazy zero-interest world, massive liquidity that we've created over the last 10 years.
And we'll get to, in a minute, amongst other things, a column you wrote about some things that the government could do in the short term. But, go to the point of the real economy. Wages are stagnant, household costs are higher than ever before. People have jobs, yes, but they're nervous of job security. People don't feel particularly confident. The government says everything's okay. You can sense it there in retail spending numbers. You can certainly see it in business confidence. And of course, this next move to start having to pay people 12% super, which, that's where any wage growth you might have will go. And business are feeling that pain, which means they hold back from employing an extra person when they thought they might. These are some of the other concerning issues as well, aren't they?
Yeah, look, certainly that's true. I just hope with this IMF report, which I think we can kind of take with a grain of salt, I don't think it really adds too much new information. The IMF just tends to follow everyone else. But I do hope it reminds the government that there are plenty of things that they can be doing to prompt economic growth here. I mean, it really does seem, since the election, they've been sitting on their hands, they've been enjoying their surprise victory, which is fair enough, I suppose. But as you say, there's really very little happening in a reform sense, and there's atmospherics, if you like, of tax cuts. But the reality is that tax is still going up very strongly. Indeed, if I can just give you one statistic, I mean, this is something that that the Deputy Governor of the Reserve Bank made in a recent point. He said personal income tax collections in 2018 went up 10%. So that is an extraordinary increase in 1 year. And it's just a reminder that just as the government is making very, very tiny tax cuts, the ATO has been cracking down on tax deductions and so forth, and that has overwhelmed the so-called tax cuts. So the atmospherics of tax cuts, I think, are completely wrong.
Yeah, look, I know. Again, it's a forecast and it's an IMF report, and it's not a holy tablet writ from God, but nonetheless, the discrepancy in the growth forecast. The official Australian Treasury numbers are a growth forecast of 2.25.
Yeah,
the IMF sub 2, it's down to 1.7. That's alarming in itself, Andrew. Even if I think sometimes the international globalists don't get it right. But going back to the point of how people feel in the economy, which is just as important for politicians as anything else, because of our high rate of immigration, per capita terms, people are really hurting.
Absolutely. In per capita terms, the economy has actually been going backwards over the last year, over 2018-19. So you're quite right. In a sense, the IMF, and as Adam and Terry said, the IMF has been sort of following local forecasters down. If you go back a year, in mid-2018, the Reserve Bank was expecting we would have 3.5% growth over the coming year. We ended up with 1.4%. So actually, it's mainly the IMF is just catching up. But this is absolutely right. The level of growth when you have such high immigration, and when also that high level of immigration is also helping to depress wages, means that it just feels very weak, actually. It's not, again, we don't want to exaggerate too much. Jobs growth, at least, has continued to be very strong, and the government has continued to make headway in getting the budget back to balance, so that gives it some scope to use fiscal policy. But just to finish up, it feels weak to a lot of people, and actually this also goes to what, with what the Reserve Bank has done in cutting rates. It's interesting that it seems to have had quite a counterproductive effect on people's confidence. With rates already so low, people thinking, it doesn't feel great, the economy doesn't feel right. Now the Reserve Bank's suddenly cutting from an incredibly low rate to even lower. What is it they know that we don't?
Correct.
Why should we really worry?
Just very briefly, Peter, could I say? Just very briefly, the government's been out there, the Prime Minister and the Treasurer, saying that, oh, look, don't worry, Australian economy is still growing the second fastest rate in the G7, but of course that isn't adjusted for immigration. In fact, we're growing much, much more slowly, indeed more slowly than Greece, I might add, on a per capita measure in the most recent year. So I really think the government has to stop speaking in these aggregate terms. I think it really is starting to frustrate people when you continually hear about these 29 years of uninterrupted growth, when the reality, which I think people are seeing more and more all the time, is that the economy is not in great shape.
Well, Terry McCrann, you'll remember when John Howard said Australians have never had it as good as they've got it, and they didn't feel like they had it good, and of course that meant quite a depressor on his political message, because he was trying to tell them, stop whinging, it's all okay, you're doing really well, and they didn't feel like they were doing well. I guess that's the risk that the Prime Minister and the Treasurer face. But I did watch the Labor front bench today when the IMF report was a big subject of question time, salivating at the opportunity to put some sort of economic wood on the government, because everybody knows if that mob had been on the other side of the Parliament after May's result, things would be in a far worse situation with that raft of broadly incredible, i.e. not believable policies.
Well, clearly the thing that is fundamental to all this is animal spirits, both the confidence of consumers and the confidence of business. And if indeed Labor had won and we were waiting for all those tax hits to impact, across the board in terms of being negative for investment, for entrepreneurs and for individuals investing, anything we're saying now about the state of the economy would be dramatically worse. As you say, Peter, I think, picking up again on the interest rate question, I think both the politics and the reality of interest rates have flipped. I think now the negative impact of cutting interest rates is far greater than any positive impact, even if you get, quote-unquote, banks passing on those rate cuts in full. I think the negative impact in terms of saving and confidence of consumers is far outweighs any marginal benefit you might get on the borrowing side. And I also think the politics have changed, that there are far more annoyed and very angry savers out there than there are any borrowers who are, unhappy because they've only got 15 points rather than 25 points from the Reserve Bank.
Yeah, and I think that's been the sense when you're listening to people, when you read the commentary in particular, Andrew. But I mean, one of the things that does bemuse me that the government's immediate response was to sool in the ACCC dogs on the banks. I mean, we see that for what it is, don't we?
Yes, I mean, I think that's the customary reaction. Again, it's not just the coalition. Both sides of politics do this when they don't really have anything they actually can do. You have another inquiry. The frustrating thing additionally is that actually the big banks then often have a big whinge about this, and they say, oh, there's so many inquiries and so forth. Whereas actually, again, often having these sort of inquiries actually is helpful to the big banks.
It gives them cover.
It gives them cover, and they have big teams to handle all of these regulatory burdens in a way that their smaller competitors don't. So it's actually a competitive disadvantage to their smaller rivals to have to respond to all these.
Well, that's what we saw in the GFC. You know, we basically, as a country, wiped out that second tier of competitive banking because the only people that could bear the post-GFC regulatory load was the big guys. Anyway, we're going to take a quick break. When we come back, I want to talk about, I want to talk about a range of things. Just stay with us.